Hello, friend. I'm your friend Costa, an investment professional. Questions from different sources. So today we'll discuss on one very frequently asked question to me: the how to invest for wealth creation or wealth building. So in this particular video, I'll try to explain you the same. So as always, let's start from the basics. Wealth creation is a journey that requires careful planning, disciplined execution, and deep understanding of investment landscape. What does it mean? You are in the process of wealth creation. So that point of time, you need to have clear plan in your mind, in your Excel, in your writing pad, wherever may be. You should have clear plan in mind. Only planning is not enough. After that, discipline execution is required. Initially, we may, when we started our plan, that point of time, we may decided to invest through SIPs or some lump sum for a certain period. But suddenly, maybe, maybe impulsive buy or some other circumstances may come. We may stop SIPs or withdraw some fund. But that point of time, we need to clearly understand it may hamper our long-term goals, long-term plan. That is why disciplined execution is one of the key factor. Third pillar is deep understanding of investment landscape. So, different time, different market cycle comes. Okay. Sometime equity may do good, sometime gold may do good, sometime higher interest rate scenario, that point of time bond may do good, or sometime fixed deposit may do good. Okay, sometime real estate may do good. So you need to understand the investment landscape very carefully, and then based on that you need to shift your investment from different asset class to asset class based on your risk appetite and investment horizon and other lot of factors involved into that. We need to understand what is your risk tolerance. What does it mean? See how much risk you can able to take. So based on that we may uh, uh, ask you to take some product, or say for example, if someone is very starting of their career and someone is near to retirement, so both risk tolerance is totally different. Someone who started their career, so for them we may invest aggressively into equity, and someone who is near to their retirement, that point of time we may do lot of diversification in their portfolio in different asset classes. We need to understand that every portfolio has three stages. One, it is like this. First stage is accumulation stage. When you are accumulating your um, investments, you are doing SIPs, you are doing small investment savings, like accumulation stage. After certain period, it would be accumulation and the management. Accumulation, and then we need to do risk diversification. More risk diversification along with accumulation. Third stage may be more into, it's like a management risk diversification, uh, and then that accumulation part would be lesser, and the last stage would be, it would be like receiving end. So that point of time it is like a after retirement you are receiving your pension. So these three stage we need to be very much clear in our mind. Every portfolio will have this, will definitely will go through in this particular three stages. Next is time horizon. Time horizon is very much important because based on this particular time horizon, we need to allocate your funds. Say for example, you may have one goal in next 1 year, one goal in next 2 years, and one goal after 7 years. So in three stages, our allocation would be different. Where you have one goal less than 1 year, we should not go aggressively on in equity into that. Over there, actually, we should be very much into lesser risk oriented asset classes. Okay, so that is why time horizon is very much important. So that is why sometimes you will see the two friend when, because in my around 18 years of uh, WACX, so I have done financial planning for lot of people. Okay, so I saw when two people, two friends came together, and when I constructed their portfolio as per their risk appetite and their goals and all this particular thing, that point of, and yeah, one important thing, in this world everyone is unique. Their risk appetite, their circumstances, their cash flow, everything is unique. Okay, so when they came to me, when I construct a portfolio, A's portfolio return may not be equal to B's portfolio return because of their asset allocation. So that is why you should be, so you should not compare two means overall when you are talking about overall your asset, overall your investment, these both portfolios should not compare each other, because here maybe their circumstances, their dependencies, all these things may be different. Maybe here two people working, maybe here one people working, maybe here there means two childs, here maybe one child. Here they may have ancestral properties. Here they may uh, actually they may not have ancestral properties. They may have dependents parents. So so that is why everyone is totally different. Two portfolio, two people should not miss. It is not apple to apple comparison. Okay, so both the portfolio should be totally different. And when we do the review, we should do review in different lens. So it is like how much allocation we have given to which asset classes and accord and why, and on that basis how much return, and on that basis actually risk, how much risk we have managed, and based on that how much return we have delivered. So that is that, in that way you need to think. Okay, then financial goals. So each individual is totally different. Someone wants to first finish their means domestic tour. Someone wants to go first finish their 2 3 foreign tour. Someone actually they are happy to uh, send their kids to basic education. Someone wants to give their kids international education. Someone is like they're happy to actually post retirement. They're happy with 1 lakh of means pension, or with inflation adjustment. Someone wants 2.5 lakhs of pension with inflation adjustment. So that is why everyone's goals is totally different. So when we construct this particular portfolio, we need to see it should be very much personalized, it should be very much customized. Diversification. So based on different risk profile, risk appetite, risk tolerance, time horizon, financial goal, we need to diversify our portfolio in different asset class. So if I see in broader level, careful planning, then discipline for the execution, and then investment landscape. See, out of that, we need to see key what is this particular, what is your risk tolerance, then what is your time horizon for different goals, what is your financial goals? Then, based on your risk appetite, what could be your investment diversification? Okay, so someone, few people came to me and tell me, ki Kaustav, actually, I have that much of money. I need highest return in the industry. I told them, ki, thank you. I'm not the right guy for you. So I cannot give you the highest return. In fact, we don't talk about return. Okay, as I'm a registered distributors, so I should not talk about return. So in fact, we don't talk about return. Okay, so so it is more into based on your risk appetite, your time horizon, how much risk you can take. In that basis, we will do the allocation. Okay, yeah, and someone will have that expectation because of actually I have that much of money. Give me, tell me which product I'll invest so that in particular time horizon it would be double. It is decent ask. Yes. So accordingly, we may tell the risks, what is the risk involved in this particular product, and what is the return expectation that should be conservative. And then based on that, we tell and we see the his risk tolerance also, time horizon also, and then accordingly we may tell them what are the right products. Equity investment. Equity means direct equity. Direct equity shares. Then maybe mutual funds. Then maybe your ETF, exchange traded funds. Okay. So these particular products, it is like linked to, I think, inflation adjusted return you can expect. It's like more than inflation. Uh, Actually, when you want to beat your inflation, you can invest into that. Averagely, expectation should be in 5 years average. Direct equity could give you around how much? 12 to 15 kind of return. Mutual fund 10 to 12 kind of percentage kind of return. Exchange traded fund in this particular range only also. But but see, this is the expectation. Expectation should be conservative enough. Maybe I have client where I have actually my client actually got in 1 year more than 100% return also. But when we'll do the planning, when we'll go for the discussion, we should not, in our mind, it should not be there. Okay, because when it is like equity oriented investment, it depends on a lot of things. Lot of factors are depending on that. So, and few factors it means no one has control into that. Okay. So say for example, what would be the global scenario? Okay. What would be the global demand or domestic overall sentiment? Okay. Lot of things are there. So that is why uh, equity investment are subject to market risk. Before investing into that, you need to understand the risk involved in that. So your investment professional should tell you what are the risks involved into that, and what is the, because a lot of time what happens when people come to you, they talk about return first, but you should understand risk and return both the parameters, and what is the technicality into that. Okay, and what is the valuation in this particular thing. You need to understand the valuation also. Valuation means, say for example, P ratio, price to earning ratio. How much price? Acha, okay. So equity is nothing but you are investing into one business. Okay. Say for example, you are taking one shop near you. So over there, how much money you are putting into that particular stocks and how much income you are getting from that particular stocks, that is called PE, price to earning. How much price you are paying and what is the earning you are getting. Okay. So by that you can understand the valuation and other parameters also there. This is one of the very effective parameters. So this is the thing. When you go for the mutual fund, lot of things you need to consider. Actually, what is the fund manager style? He is more into growth strategy or contra strategy. Okay, so different this or value strategies. So different fund manager has different styles. So you need to understand their style, and right now in market, what is going on in the market. Okay, and what would be the upcoming news? Because when we are investing for the future, and you need to understand the future trend. Okay, so you are not investing for your past, you are investing for your future, right? So that is why lot of things you need to consider over there. Apart from this, also what are the allocation, which are the sector allocation. When you dig inside, lot of things are there to understand. Okay, that is why if you understood is good enough. Otherwise, go with any professionals or mutual fund distributor or investment advisor. So who understood all this technicality and who can explain to you. Okay, and preferably go with financial planning or retirement planning kind of approach, so that see, end of the day, when you are doing your, when you are earning, okay, so you need to have some goals, right, in your mind. Ki in your life, you need to achieve something. Okay, it is how effectively you can achieve your goals that is important. Okay, so how so that is why financial planning and retirement planning is very much required. Now come to next option is debt investment. What are those? Like fixed deposit. Fixed deposit is one kind of debt instrument. Then PPF, Public Provident Fund. Then your debt mutual funds. Apart from this, there are bonds. Bonds are there, different corporate bonds, government bonds, GSEC bonds, 10-year GSEC bonds. So like lot of these are comes under debt instrument also. But here we just capture some popular debt investment by which retail investor also can participate into this debt investments. So in this case, most of the debt investments are fixed in nature, but their risk is lesser, as well as return also lesser. Most of the things. I'm not telling you all. Okay. Here, so you need to, before you invest into that, you need to understand the nitty-gritty of that particular thing. Okay. So that is also very much important. Now, real estate. So, real estate is one of our traditional investment process. But if you see, means when it comes to real estate, two, three, one is liquidity issues are there. When you invest into real estate, say for example, one real estate is 2 crores. So from there, how much return you will get? How much maybe um, how uh, how how much maybe rent will you get? Okay, always will you get good tenant, or can you manage it, or can you manage it properly? So this is also few questions you need to ask, because it is a very huge investment and it is a lock-in investment as well. And here two three things also required, which is the means position of this real estate, and over there what is the future of this particular area. So that is also very much important when you are considering residential real estate. Then commercial real estate. Real estate, like your commercial office space or shop space, this particular thing. So that is also you need to consider. This is also part of your part of investments. Then REIT fund. So real estate investment trust fund. So this is also like mutual fund. It's like a pool of money. They invest into real estate projects, and from there, whatever the return and they generate with a particular time period, that return they actually distribute across the investors. But practically, lot of technicalities are there. Say for example, you invested in this particular fund in a different expectation that much. Say for example, you invested into hotel project, and over there that much rooms are there, so you thought keep that much room would be occupied, averagely that much room would be occupied. But for some reason, if COVID kind of situation comes, then this particular very big investment may be stuck. So here, a lot of positive and negative things are there. For diversification purpose, yes, it is a good physical assets. You can, when you have different asset class investment into, when you have invested into different asset class, that point of time, definitely you will consider over here. But for your own living, one real estate is your emotional asset, and you should invest into that. This is an investment. It is like you need to have one real estate for your emotional asset. Plus commercial place also you need to, if you are doing something for your business, so you should have. But for investment purpose, it is like a second or third onwards, it is like your investments. Now, commodity or gold. So gold also one traditional investment asset class, and people think gold is the safest haven. So when there would be uncertainty in the market, in the global in the market, or in the global scenario, there is war. So that point of time, people think ki at point of time business will not do good. So they take out money from equity or debt, and they put into gold. They think ki gold is the safest haven. Okay. Then, so that is why people actually purchase lot of, in India, a lot of jewelry. That particular tradition is there. People are investing into jewelries. They are wearing jewelries, and this is the one symbol of prosperity. Uh, physical gold is one thing. Second is gold ETF. ETF means exchange traded fund. So that so you may invest into that ETF format also in gold. It's like a digital format. Third, through mutual fund also you may invest into gold. You may invest into other asset class like silver, crude, then different metals, then grains, etc. Apart from this, there are other investment options also there, like your currency, different countries' currency, USD, INR, pound, yen, all those things are there. Now comes to alternative investment. Alternative investment, nowadays people are investing into startups. What they are doing, when any new entrepreneur came with a new idea, and they think yes, this is a good um, when they think it is a good business and there are opportunities in the business, then people are investing into that with the expectation of higher return. Okay, over there, lot of risks involved into that, because as it's a startup, it is a high risk, high return kind of proposition. Now, next is cryptocurrency. So this is also one kind of new asset classes. So here most of the asset class I have covered. Apart from this asset class like painting, like antiques, these are also different asset class. So you need to, when you have a different kind of threshold, that point of time you need to do diversification into different asset classes. Now, strategies. Now, so first we high level things we have discussed. Then we have discussed what are the asset class you can invest. in granular level. Now we are talking about what are the strategies. Okay, so one strategy is you should start early, invest early with a small amount. You just start early. So whenever you start earning, that point of time, you may start your investments. It will help you for power of compounding. Okay, systematic investment plan is a very good option. So you may start regularly and as much as possible you can start. Maybe after all your means, for that you need to do your budgeting very carefully. Next is diversify your portfolio. So you must diversify your portfolio in different asset classes like equity, then debt, then real estate, then gold. All this diversification you may do the diversification. Next is stay informed. So you need to understand means whatever you are investing and wherever you are investing, you need to understand the technicality of that. So you need to be informed and you need to be informed your tax implementation as well, plus the asset class where you are investing that you need to invest in means consciously. Now rebalancing. So periodically you need to do your rebalancing. So based on your risk appetite, based on your overall your asset class, based on time horizon, time to time basis, you need to do your rebalancing. So one method is uh, if you are aggressive investors, okay, that point of time you should have 70% into equity, 20% into debt, and 10% into gold. When you are moderate kind of investors, 50% into equity, 30% into debt, and 20% into gold. If you are conservative kind of investors, post retirement for your uh, post retirement for your maybe inflation adjustment, you may do 30% into equity, 50% into debt, 20% into gold. Okay, but it is a thumb rule, but it is not equal for everyone. Okay, everyone is different, everyone thought process, their risk appetite, everything is totally different. So based on that, you need to take your call. Okay, so it is like that is why personalized financial planning, personalized retirement planning is required for everyone. So this tailor-made things is very much required. It is not fit for all kind of thing. Consider tax impact. That is also very much important. So here, when you are investing, so what is the tax impact on that? So will it comes under capital gain tax? If it is capital gain tax, what is the long-term capital gain tax? What is the short-term capital gain tax? So hope you understood this particular concept. But here, so you may ask me, Kaustubh, then why means where it comes under direct equity like mutual fund, PMS, AIF, this kind of things. See, these all are approach, uh, different kind of products. Okay. Say for example, people may invest into instead of putting into different asset class, maybe one multi-asset fund they can take. Okay, over there, actually fund manager will invest into equity, debt, your gold or silver, then REIT, these particular things. Maybe here in equity also, as per your risk appetite, you need to invest into large cap, mid cap, small cap. In fact, you may, when your portfolio is maybe around 2 crore, 3 crore, that point of time for diversification also, you may invest into means, PMSs. Uh, so there are different things, different strategies, different things are there. That is why your product distributor or your investment advisor will guide you accordingly. So that is why before all these things, You need to understand your risk appetite, risk tolerance, and these all part are very much important. And investment is not for miss. It is not keep my neighbor is doing that and all the people is doing like that. So I'll go with that particular line. No, it should be customized. So yes, you should contact us for customization, customized financial planning, and accordingly we'll help you out as we are product distributor, will help you out for the execution for this particular end-to-end discussion, end-to-end solution. You can come to us for financial planning, retirement planning, goal-based planning, and actually we are distributor of almost all the product which is available in the industries. So yeah, you may contact us in this particular thing. So in you may reach out to our you may go to our website, you may see our quality policy, you may see our process. Okay. So, yes, right now we are managing good number of customers across India, different cities of India, and NRIs from different countries. Definitely, wherever any part of the world you are, we can help you out. Our entire process is online, but if you are in India or like any part of India, if any offline process also there, that also we will arrange our person from our partners team. Definitely they will reach out to you and do the needful things. So yes, happy investing. So now hope you understood how to invest and create wealth. So that is why again I am telling if this is not a one-time activity, it is a process. It is a this particular process in very disciplined way. You need to perform it, and definitely you will get the things. Normally, I saw people when cross 40, 45, that point of time, they are more conscious about financial planning and retirement planning. Before that, people are actually they don't take it very seriously. But yes, as soon as possible, you should take it whenever you are starting your earning. By small way, small impact will go. Small impact will small investment when it comes under power of compounding, it will have a very big impact. Okay. Thank you. Have a nice day. Stay tuned. Thank you.